Exactly what just happened in the silver market. Silver ripped higher again, smashed straight through the low 90s, and in the middle of the trading day it flirted with a kind of number that makes markets seriously nervous. Not someday nervous, today nervous. Around the world, exchanges started tightening their screws immediately. Dealers started changing their quotes in real time. And regular people started asking the same exact question at the same time. Is this the moment the silver market finally breaks out of the cage? Because when silver is moving like this, it isn't just a price chart bouncing around. It's a stress test of the entire system. And today's stress test was absolutely loud. This is MarketPulseUSA, and as this is being recorded, silver has been trading near $93 after an explosive run that's been building for months. If you felt like the move came out of nowhere, that's the entire point. These are the kinds of squeezes that look slow right up until they don't. And then suddenly the headlines show up after the smart money already moved. Now, here's the part that should get your attention immediately. The people who run the casino are trying to make the casino way more expensive to play. In plain English, a major futures venue has been aggressively hiking margin requirements on silver contracts. That means it costs way more cash to hold the exact same position. And whenever you see that happen in a fast-moving market, there are only two honest interpretations. Either they're trying to calm volatility so the system doesn't wobble, or they're trying to force weaker hands out because the move is going in the wrong direction for them. So the question is simple: which one is it? Because if the goal was stability, you'd expect the market to cool off. But that's absolutely not what's happening right now. Price keeps pushing higher. People keep showing up to buy. And the more the rules get tightened, the more it starts to feel like silver is doing that thing it does in rare moments, ignoring the gatekeepers completely. And if you're wondering why this matters to you, even if you never touch a futures contract, stay with me. This margin story is the first domino falling. The next domino is retail demand, and the domino after that is physical supply. And supply is where things get extremely uncomfortable. Now, quick note before we go any further. My analytics show a huge chunk of you watch these videos regularly, but still haven't subscribed to MarketPulseUSA. If you get even a little value out of this content, anything that helps you think clearer, protect your money, or spot what's coming, hit subscribe right now. Drop MarketPulseUSA in the comments so I can see who's really riding with us. All right, let's get back to the fire. When silver runs hard, you usually see three battles happening at once. Battle one is paper positioning, leverage traders, option expirations, margin calls, forced liquidations. That's what you see on the screen. Battle two is physical reality. Bars, coins, scrap metal delivery obligations, refinery capacity, and the awkward fact that you can't print metal. Battle 3 is psychology. The exact moment normal people start saying, wait, should I own some of this? Most people stare at Battle 1 and completely forget the other two exist. But the real explosions happen when Battles 2 and 3 sync up. And right now, they're trying to sync. One of the most interesting tells in this move is how contract sizes are being repackaged to steer behavior. When you see smaller contract sizes pushed into the spotlight during a mania phase, it's usually an attempt to redirect traffic. It sounds friendly. More access, smaller units, more participation. But it can also be a pressure valve trying to keep retail enthusiasm contained inside a product that's easier to manage. And at the same time, margin rules are shifting from simple dollar amounts into percentage-style requirements because the price is whipping around so hard that the old system can't keep up. That alone tells you the move is absolutely not normal. If you've ever watched a market get tight, really tight, you learn something important. The price isn't just a number bouncing around, it's a signal. And when the signal gets loud enough, institutions stop pretending. They adjust the rules. Now let's move from paper mechanics to the physical street level, because this is where the story gets real, and where you can feel the pulse without needing any fancy terminal. When silver is climbing fast, the official mints and the big-name retail distributors start acting strange. Product pages go blank overnight. Out-of-stock banners multiply, items disappear and then reappear with new pricing a day later, shipping dates stretch, allocations get rationed, and, the biggest tell of all, the premium over spot starts doing things that don't match the headline price. You might see spot at 93, but you go to buy a basic ounce, and suddenly it's 101, 103, 105, depending on what you're trying to get, and who can actually deliver it. That gap is not decoration, that gap is stress. And stress always reveals the truth. In a fast market, the physical supply chain becomes a funnel. Silver doesn't teleport from the earth into your hand. It goes through miners, refiners, fabricators, wholesalers, and dealers. Every one of those links has capacity limits, and when price surges, two waves hit the funnel at the same time. Wave one is sellers. People who've had old coins, jewelry, flatware, and junk silver sitting in drawers for years suddenly decide to cash in. Wave two is buyers. People who didn't care at $25 start caring at 70, and people who started caring at 70 start panicking at 93. Both waves jam the exact same narrow pipeline. And that's why you can see something that confuses beginners. Lots of people selling yet premiums rising. How can there be a shortage if everyone's bringing silver in? Because the bottleneck isn't silver exists. The bottleneck is silver gets processed fast enough. Refineries can only handle so much input at once, and they have preferences. If you bring them low purity scrap, it can take more time, more steps, more headaches. In a surge, they'll prioritize what moves fastest. That can leave piles of lower grade material waiting, even while demand for finished products is screaming. So dealers sit in a weird spot. They're seeing incoming metal, but they can't convert it into sellable inventory quickly enough. And that's when premiums inflate. Now, here's something most people miss. Premiums don't just rise because of greed. They rise because replacement becomes uncertain. If a dealer sells you a pile of ounces today, they need to know they can replenish. When replenishment takes weeks or months, the price you're paying includes the risk that the shelf might stay empty. And empty shelves create the most dangerous emotion in markets: urgency. You've probably noticed that when price spikes, some dealers quote wide, some quote conservative, and some simply stop quoting. That's not because they don't like your business. That's because in a runaway market, the fastest way to go bankrupt is to sell inventory you can't replace. So let's put a spotlight on what's happening right now at the grassroots level. In the last few weeks, foot traffic at many local coin shops has started to change. You still have the classic sellers with boxes of old silver, but you're also seeing something way more important: first-time buyers. I've never bought metal before, but crowd. That's the crowd that turns a steady bull market into a chaotic one. And because sellers are finite, everyone has only so many drawers to empty, but buyers can multiply. And retail buying is the thing paper markets fear the most. Because retail buying isn't about leverage. It's about taking metal out of circulation permanently. Retail buying is sticky, and sticky buying is how squeezes become headlines. So if you're trying to understand why the big exchanges would tighten margins, you have to think like the risk managers. Their nightmare isn't silver up $3. Their nightmare is silver up $3 while physical drains. Because once physical drains, paper promises start looking less comfortable. And this is where the conversation gets even spicier, because there's a second layer that's been whispered about all over social media. Big short positions getting clipped. And when a big player shorts silver, they're basically betting that price will go down or that they can manage risk if it goes up. In normal times, they hedge, they roll, they dance. But in abnormal times, abnormal things happen. Stops get hit, losses get realized. And sometimes a trade becomes too big to hide. There have been reports circulating about major stop levels around the low 90s area. If those levels were real and they got triggered, that's not just a bad day. That's forced buying. And forced buying in a tight market is gasoline. Now, I'm not here to verify rumors line by line today. The bigger point is this: the market is behaving like a system under serious pressure. You can feel it in the way margin rules are changing. You can feel it in the way product availability is changing. And you can feel it in the way people talk about it. Because suddenly everyone has an opinion. And when everyone has an opinion, the move is already mainstream. But here's the twist. Mainstream is late. The real move often happens after the first mainstream wave, when the system tries to cool things down. And then the next leg higher arrives anyway. That's why staying informed matters right now. Because the next leg doesn't usually announce itself politely. It arrives when you're distracted. And I want you to keep one specific mental picture as we go forward. 2 clocks. Clock 1 is the chart clock: candles, dips, bounces, headlines. Clock 2 is the inventory clock: weeks of lead time, refinery backlogs, mint delays. Most people only watch clock 1, but clock 2 is the one that detonates surprises. Now let me talk about what dealers are seeing on the front lines, because this is exactly what you would expect in a silver surge, except more intense. The shop can go from quiet to non-stop in a matter of hours. Not because of one whale, because of volume. Many smaller transactions stacked on top of each other, plus constant incoming scrap. And that's the part that sounds healthy at first, until you realize what it does to the system. If a shop is buying a mountain of silver from sellers, that seems like supply is pouring in. But if at the same time the shop is selling to new buyers, that means silver is changing hands, and often leaving the market in a more locked up form. And locked up metal doesn't flow back easily. A seller sells because they want cash right now. A buyer buys because they want protection for years. Those are not symmetrical motives. So even if you see a glut of scrap on the selling side, it can still translate into scarcity on the finished product side, because the converting process is slow and the new holders don't flip it back quickly. And that's why you can see an environment where a dealer can say, we're buying a ton, and also say it's getting harder to restock. Both can be true at the same time. Now let's talk about premiums abroad, because this is another clue that a lot of people ignore. When you see higher local premiums in certain overseas markets, meaning buyers there are paying significantly more per ounce than buyers somewhere else, that's a sign of uneven distribution, different demand intensity, and sometimes restrictions that distort the flow. It can also be a sign that physical metal is being bid up where it's hardest to obtain, which is a whisper of future stress elsewhere. So if you hear about premiums in one region running far above another, don't just shrug. That spread is information, and spreads like that don't stay quiet forever. They either normalize or they widen and become the story. Now here's where we need to talk about the supply chain in a way that most channels won't, because it's not as flashy as a chart, but it is the heart of the matter. When price rips higher, refineries get slammed. They get slammed by inbound material from the public, and they get slammed by downstream demand for fabricated product. But their capacity doesn't double overnight, so they triage. They prioritize higher purity. They prioritize material that can be processed quickly. They prioritize relationships. Because in a shortage, relationships are everything. And that's why some networks are able to keep minting even when big name products vanish. If you have dedicated refining slots and prearranged capacity, you can still get product out. If you rely on the open market for refining time, you can get stuck in line. That's not a conspiracy. That's logistics. And logistics is ruthless. Here's a quick scene that captures the mood. A customer walks in with a small canvas bag that's clearly been sitting in a closet for years. Inside are mixed coins, a couple of worn bracelets, and a stack of old rounds. 10 minutes later, another customer walks in with a totally different energy. Phone in hand, chart pulled up, asking, "Do I still get it close to spot, or is everything 10 over?" The dealer answers with the only honest response in a fast market. "It depends on what I can replace tomorrow." That's how you know a market is transitioning from normal to urgent. And here's the sneaky part. The public usually notices the price first, but the professionals notice availability first. Price can be argued, availability can't. When you see delivery dates stretch from days to weeks, when wholesalers start quoting allocation only, and when a product suddenly becomes call for pricing, that's the market whispering that the next phase is closer than it looks. So keep your eyes on the boring details, because the boring details are where the truth leaks out. Now let's bring this back to you, because I know some of you are thinking, okay, but what do I do with this? First, understand what kind of market this is. This is not a calm, polite, low volatility market where you can wait for the perfect entry and get filled quietly. This is a market where gaps happen. This is a market where you can wake up and see the price $5 higher and the inventory $10 higher. And in markets like that, the most common mistake is chasing emotionally. So instead of telling you to chase, I want to give you a framework. There are two categories of people watching this. Category 1 is already positioned and wants to know if they should sell. Category 2 is not positioned and wants to know if they missed it. If you're in Category 1, the question is, what is your time horizon and what is your purpose? If your purpose is long-term protection, you don't let a fast move trick you into doing something you'll regret later. Fast moves often include brutal dips. If you can't handle dips, you should size accordingly, not panic accordingly. If you're in Category 2, the question is, do you want exposure or do you want a perfect price? Because markets rarely give you both. If you want exposure, you can enter in a disciplined way, rather than in one emotional bite. And yes, there can be violent pullbacks, options expirations, margin hikes, liquidity squeezes. These can create sharp downdrafts. But here's the key. In a true bull phase, pullbacks are often shorter than people expect, because dips get bought. And the reason dips get bought is because the underlying forces don't take a day off. Currency debasement, risk hedging, industrial demand, and geopolitical uncertainty. Speaking of uncertainty, let's zoom out, because silver doesn't move in a vacuum. It moves in a world that's feeling more fragile by the week, when people feel the ground shifting, when they see tensions, sanctions, conflicts, instability. They reach for things that historically survive. And metals are the oldest version of that instinct. You don't need to agree with every narrative you see online to understand the behavior. You just need to understand incentives. People want assets that don't require someone else's promise. That's why during turbulent periods, you see capital flowing toward hard assets. And once capital starts flowing, it tends to keep flowing until it hits an extreme. If you found this useful, subscribe to Market Pulse USA right now. Drop Market Pulse USA in the comments. In our next video, we'll break down what happens when silver prints triple digits and what the first emergency moves will be. This is Market Pulse USA. Stay sharp, stay informed, and I'll see you in the next one.